Good afternoon. My name is Gareth Rees. I'm a product director at Experian. I'm working in the business information group, and I'm going to spend a few moments this afternoon going through an overview of how data and insight that can be derived from that data can support the right customer management strategy in your day-to-day working lives. So, as many of you will know, Experian is uniquely positioned to provide insight on what is happening across the credit landscape today as the COVID pandemic crisis has unfolded. As many of you know, we collect data from hundreds of different suppliers of credit data on information relating to small businesses across the lending, utilities, trade credit, telco, and insurance markets. And this data is collated and updated and processed on a daily, weekly, monthly basis, whatever the frequency might be. And so we have access to a substantial wealth of commercial data on the UK business market that puts us in a really strong position to be able to help guide you and support you in ensuring that you're making the right decisions on your small business portfolios. Over the last 7 months, obviously, we've seen a huge amount of change in the UK market as a result of the COVID pandemic. And it's given us the ability to adapt our data and services to give as much support to the market as we can during this current crisis. And as part of that support, we've actually been working with central government to provide the relevant insight and analysis to support in a lot of their policy decisioning to ensure that they are able to target and support the right segments of the marketplace today. As we all know, different sectors have been impacted at different levels to different extents, and obviously getting that detailed view of what particular sector impact is really important when it comes to knowing what support is needed and where and when as well. Now, over the last few weeks, there's been a lot of talk about the green shoots of recovery and the fact that actually the recession that we had entered was not going to be quite as severe as potentially it was forecast to be. The UK economy in the third quarter grew by a record 15.5%, albeit it remains nearly 9% smaller than before the pandemic. But there seem to be many reasons to remain optimistic. Now, what we see from a credit perspective and a credit mark reflection is that there is a question mark around how strong the economy actually is. And what I wanted to do is just talk through some of those interesting viewpoints that we have been able to extract and build on and give an idea of how and why data and the insights that the data can provide is going to become more and more important on a day-to-day basis. So there's been some really interesting and in some cases quite surprising results since the crisis has started. So over these past 7 months, I think, as most people will already be aware, the increase in debt has been unprecedented. I know that's an overused word these days, but it really has. There's been a 30% rise in the amount of debt out there year on year. And some key sectors, and obviously you can probably guess what some of those sectors are, being the leisure, tourism, hospitality sectors, have seen increased borrowing by 50% or more, which is a significant impact to their turnover. And overall credit turnover for the past 6 months is down around 10%. And some of those hardest hit sectors have seen a 30% decrease in the amount of credit that they receive since when you compare to the spring and summer of 2019. And this really does start to raise concerns around the levels of risk that are out there in the market. There are other elements that also help indicate and demonstrate signs of distress and data that we build and collect through payment performance, trade credit payment performance data, which is always a very good and relatively predictive way of identifying early warnings of stress in a business. And what we've seen is all businesses across the board are paying their suppliers about 20% later than they would ordinarily have done back in January of this year. And those sectors that have been most hard hit by the pandemic are reducing or actually slowing down the frequency of payment to their suppliers by 50%. So a significant impact, even though there has been a lot of financial help. There is a significant decrease in the ability of businesses to pay their suppliers. So I think all of these come together to actually suggest, is there really hope for a green shoot recovery as early as potentially being anticipated? Certainly in the small business world in the UK, it doesn't seem to reflect that what we are seeing on a larger scale. But there have also been some surprises as well. To date, we've not seen the number of small businesses failing fall off a cliff, as I think many people would have expected to have done. And in fact, there were more business failings in 2019 so far than there have been in 2020. Now, there are different things that you can read into that. So one, obviously, is all the government subsidies that have been made available and obviously are beginning to help and have helped the small business market through this turbulent period. But also, I think we need to take into account that the likes of Companies House, etc., have put on hold the strike-offs up until sort of September time, when we did see a spike in the number of businesses failing. But if we look at what, at this time last year, we'd already seen nearly 400,000 liquidations and receiverships and administrations, whereas this year to date, we've seen currently around 250,000. So it begs the question, how, that the support the government is giving is absolutely working, but at what cost are we supporting these businesses? So if I look at look at the pre-crisis, and I think about what a lot of banks and lenders were focused upon, it was very much around improving lending and improving that whole lending experience and enabling businesses to get faster access to the right funding when they need it. We were also seeing a gradual shift, particularly in the more traditional high street lenders, to a more digital experience for their customers. But as the pandemic hit, we saw a fundamental shift in the dynamics and the focus for a lot of these lenders and banks. And it's very different to the makeup of what we see through our research and anecdotal conversations with lenders out there as to what their primary focuses are now. Obviously, at the beginning of the pandemic, there was a huge focus on being able to process the loan applications that were made available through both CBILS and BBLS. And that, whilst that continues today and has obviously been extended over the course of the last few months, focus has now shifted somewhat to look at the impact of the debt mountain effectively being generated on how that has actually impacted portfolio risk, and looking at how we might have to work to continuing to sustain the small business market and preventing the number of defaults and dissolutions as potentially might happen. So we all know that through CBILS and BBLS in particular, there is a high likelihood that there is a high amount of fraud within the applications and approved applications that have been made. We can see that, and that's evidenced through the National Audit Office review of the scheme. But we also know from the very early days that a lot of businesses had no intention of paying back this debt. So what does that really mean? Obviously, it puts a great deal of stress on the lenders who have had to provide this type of lending. Where you think about nearly around £60 billion has already been lent to about 1.3 million businesses to support them. And therefore, how do you deal with that amount of debt? And as I said, some of that is obviously quite risky. And how do you manage as efficiently as possible your small business portfolios? When we look at who's taken out bounce back loan schemes, a quarter of those business would be considered to have been maximum risk based on our commercial Delphi score. So already the fact that detailed credit checks didn't have to be made does already pose a significant risk to the debt being taken on by the lenders. If we look at historical revenues and costs and current account balances, the affordability estimates would suggest that 35% of the highest value bounce back loans taken out are unlikely to be easily affordable in the future. So if we think about that, there's about 13% of bounce back loans where that have been drawn down despite their value being greater than the money going into the business account over the last 12 months. Well, 13% doesn't sound very much. When you think 13% of around 1.2 million, it becomes quite a significant number and obviously carries a significant amount of risk. So why is this important when the government has guaranteed some of the loan book and underwritten the loan books, particularly on the bounce back loans, but also in terms of the interest-free periods that we've seen the government propping up for CBILS? So there is still a significant cost for lenders to deal with this surge in lending. So ongoing management of this risk, protecting those businesses that remain viable, and where possible, being able to reduce the need to start expensive collections processes. That would be the last course of action where the lenders currently are required by the government to initiate collections processes where businesses start to fail. How do you prevent that slide into that abyss, essentially, and that costly process that is wrapped around it? So what part does data have in playing in this crisis? So absolutely imperative that lenders have a complete view of the financial stress and status of individual businesses. And it's critical to ensuring that you're able to apply the right treatment at the right time, ensuring that small businesses are as fairly as possible to meet the needs of those businesses too. This view can only be achieved by curating data from a number of different sources, which include both data from internal sources on the lender side, so thinking about the product data, thinking about the customer data itself, KYC data, etc., that already might be in existence, but combining that then with the holistic view that a company like Experian can shed light on in terms of being able to bring together data that is available from other organizations where a small business might have credit agreements with those other businesses that might not be visible to the primary lender. So only through that lens can you understand the full credit profile of that business and the full depth of the debts that are owed, and therefore their creditworthiness. And let's not forget also, we should also take into account the creditworthiness of the directors of that business as well, to ensure that it's possible to predict default potential and failure risks. And as we've also mentioned earlier, the current credit behaviours and timeliness of paying their suppliers. Now, to give it an additional level of granularity, where possible, if you're able to consolidate and augment that view with both open banking data and data obtained through management account financial data, then you are optimally positioned to make the right decisions at the right time in the knowledge that you know that you have the most up-to-date and accurate picture of the particular business. So what do you need to do? What do we think that is important to capture? So we've talked about the huge amount of debt out there. So how do you go about understanding the concentration risk of the debt book that you have within your portfolios? Being able to understand what segments of your portfolio are under most risk, and in some cases, are there elements of your portfolio that it's almost too late to actually continue to help? Because the sector that they're in, we know that the recovery of that sector is going to take 6, 9, 12 months, whatever it might be, and the likelihood of that business failing before you hit that recovery point could be quite high. So it's really, really important to be able to understand where your levels and volumes of debt sit within your portfolio and what characteristics of those businesses make up that debt, and therefore how exposed you might be to potential defaults and failures. So understanding how your portfolio is how healthy it is versus the UK business population as a whole will help you where you might have over concentration in high risk sectors, and so it's really, really important to get that segmented view. So you also need to understand and have the data to understand the viability of that business, and therefore that can be achieved through ongoing monitoring of key indicators of the financial health of those businesses to provide any early signs of stress, and therefore that would enable you to react proactively to take the appropriate action, and therefore being able to monitor on a month-by-month basis, be able to understand where potential failings might be coming is really important to enable appropriate interventions to be made. And on the flip side of that, the converse side of that is also what businesses are actually striving, and there are businesses out there that are growing. So helping to identify your good businesses, what businesses that you want to look after and shield for future growth, for future opportunity to upsell and cross-sell, and work more proactively to see them through the next however many months that we're facing with the downstream impact of COVID. So ensuring that we monitor liquidity changes to arrears, payment performance slippage, all of those good things is really, really important to understand the viability of your portfolios, where the stress is, and how best to manage it. And then obviously, as part of managing your portfolios, early identification of those businesses that are starting to show signs of stress is imperative. Intervention measures are preferable to the costly, time-consuming and likely less well-resourced collection strategies that would need to be adopted to recover some level of money from those businesses. Therefore, again, the constant monitoring and reviewing of past and current performance will help to provide a better understanding that you'll need to know when a business might be slowly starting to fail. So taking a line in the sand, thinking about pre-COVID, the pre-COVID world, thinking about the right observation point to make an analysis, perhaps say February 2019, to understand the robustness of that business back then, taking another view back in February 2020, and then overlaying that to how a business might be performing today will give you a better understanding of the financial viability of that business. It will enable you to better understand the impact that certain measures might have in predicting stress. So thinking about debt service ratios and debt to income ratio, how those might be calculated based on both present and historic data to get a true view as to whether that business was already failing and is effectively being kept on life support by the government interactions, so zombie companies, or whether these businesses were in a strong position beforehand. They've hit a bit of a rough patch as a result of COVID, but their fundamental finances are strong enough to see them through over the next few months. So it's really essential that, as a lender, you're able to understand that complete picture of the financial status of that business. And similarly to managing portfolio on an ongoing basis, being able to interject and appropriate the right repayment strategies and to be able to assess affordability best will help you get a better grasp and handle on how to support those businesses as we go forward. So affordability and cash flow volatility are obviously going to be really key over the coming weeks and months. We've had regional lockdowns, we've had national lockdowns. So how best to continue to assess the affordability and cash flow volatility is going to be key to ensure you implement the most appropriate repayment treatments. And to ensure that from an affordability point of view, that business is actually able to service the debt that it is owed, and therefore you're not overly penalising a business that actually may recover longer term, but needs forbearance or some other measure to be implemented to keep it sustainable over the coming weeks. So if we just see from this diagram here, we can see why it's important to look at how a business is performing. In this example, obviously, you can see a healthy business. Credit turnover continues to improve. Debit turnover obviously increases at the same time, but that is in direct correlation with the fact that that business has potentially expanded, bought more stock, and employed more people to be able to increase its turnover at the same time. But being able to understand where your growth companies are is really important, so you can look after them and nurture and nurse them through the foreseeable. Whilst at the same time, this is obviously an obvious example of how a business is performing not so well, where credit turnover has fallen off a cliff, debit turnover continues to rise, and there is an absolute necessary need to intercede and look at how you might reassess the performance of that business and what measures you might need to introduce to help keep that business sustainable. So how do we at Experian believe that we can help you, and what have we done over the last months to support you in the ability to manage your client portfolio on an ongoing basis? So we've talked about concentration risk, which is really key. We've created a series of UK-wide dashboards that demonstrate and illustrate the different levels of stress across the UK business population by region, by sector, and that helps you to understand and overlay your portfolio to understand where you might have similar risks and exposures to particular regions or geographies or sectors. So that will enable you to spot signs of where you've got over concentration in those particular areas. Then we've also built a whole series of monitoring capabilities. First and foremost, the commercial volatility index, which brings together all of the key data assets that we have in the Bureau, from keys and our CCDS Cato data, our payment performance data, and overlaid that with the economic forecasting data that we also derive, and the GVA KPIs, which gives a clear indication of short-term volatility. Now, a lot of the time, we've built predictive scores that are looking to 6 to 12 months in the future. Obviously, that is not necessarily that as important at the moment as looking at the shorter-term volatility that we're experiencing. So looking at things on a month-by-month basis is really important to understanding your exposure and the pressures on affordability of those businesses. And by using aggregated indexes, it gives you an idea and a measure by which you can start to break down and segment your portfolio to deal in a logical progression. There's also an element of anticipation. So risk scores are going to be really important, not only on the ongoing monitoring of your portfolio, but also thinking about longer term as well. So you've got the short term, but we will get through this at some stage, and fingers crossed that the vaccines come into play and actually work in the very near future. So longer term, we need to anticipate where you might have future levels of distress. So thinking about future cash flow risk, thinking about future failures, being able to predict within your portfolio where that might be happening is are really important indicators of how to treat and manage your portfolio. And then finally, the continuing ability to be able to always assess business affordability. So looking not just at the business, but also at the consumer profile of the directorships, of the directors of those businesses. Are you looking, for example, are those businesses being sustained not just by government initiatives, but also personal savings or family wealth or whatever it might be? Being able to build that picture will give you a really good indication of how to build out and monitor and treat the different segments within your portfolio. So hopefully that's given you a very whistle-stop tour of what we've seen over the last 7 months or so, and will likely continue to see for the foreseeable, but also an understanding of the insights and the importance of the insights and how they can be applied to best manage existing portfolios and to make data-driven decisions based on factual evidence and historic views of the financial health and viability of the small businesses within your current portfolios. Thank you.
Thank you, Gareth. We still have you on the line. I think there's a slight technical issue with the camera, but I can still hear you clearly. So we'll move on to the Q&A session. So had a couple of questions come in. One is, how can contributed data be used to shed light on the financial status of a business to help inform risk levels?
Thanks. So yeah, that's a really good question. So just thinking about the level of granularity that both open banking and management account data can bring to the picture of the financial health of a business. So if you think about the core bureau data that a CRA holds, we can look at the credit agreements, the aggregated monthly cash flow view. But then if you combine that with real time and the recency of open banking data and the transactional basis, you can build a more detailed affordability portrait of that particular business. You can assess what their incoming and what their income and expenditure is and how that can be categorized, which gives you a better indication of cash flow. From a management account point of view, obviously get access to more recent data than you would ordinarily get from companies' house filings for a particular business, which can often be 18 months out of date. Or you may not even have that information at all for nascent and newly formed companies. So being able to access that kind of data that is contributed by the small business itself is really has a really critical part to play in this. So just as a good example, you may have a company that is over trading, where its cash flow position doesn't look particularly healthy, but it has an enormous number of unpaid invoices in the funnel, and therefore there are different treatments for those particular businesses, which you wouldn't necessarily be able to see just from you wouldn't be able to see from the data that you get from keys or CCDS data.
So Gareth, a related question to that: probably quite a few lenders are looking at or exploring the use of an open banking solution to get access to real-time data on an SME's financial position. But for those lenders contemplating that investment, what kind of questions should they be asking of a new provider?
So I think it's very important. The most important thing is what are you going to use that data? What are you using that data for? And understanding, what is the value exchange that is going to be made between the lender and that business, because that's from a contributed data point of view. But knowing and trusting where you're going to be effectively giving up your crown jewels, it's all the information that you have on your business, and giving that up to a lender. You want to know that it's going to be used for the right purpose. And in this instance, it might be, for example, to help provide or give the lender a better idea to assess affordability for repayments, for example. It gives evidence that actually that business might be looking for additional help, and it gives that clarity and insight to that lender. And I think that's one of the most important things to consider.
I think explaining the give and the get is a key component, I think, of open banking, and understanding the value exchange there. So another question's come in. This is a slightly wider generic one. So what are the principal data sets that should be considered in helping to assess risk?
So I think hopefully, as I've covered, it's looking at one data set in isolation will not give you the rounded view that you need to have to be able to understand the financial viability and risk of a particular business. And also on the flip side, we're always talking about risk. It's also about growth opportunities as well. So it's very much about how do you bring together the different data sets across keys data, so you can see all credit agreements associated with that particular business. being able to link that to an affordability assessment that could be driven through Cato or CCDS and Cato data. So being able to see that monthly aggregated view. And then finally, payment performance data as well. Being able to understand on a wider scale whether that business is actually meeting its creditor demands and whether they're paying their suppliers on time. So bringing all of that together in unison will give you a richness that that you wouldn't get by just looking at one of those data sets in isolation. And then obviously any open data, any contributed data that you can sprinkle over the top almost will just give you another lens and another level of confidence in the decision that you could be making.
Thanks, Gareth. Glad to see that you're back in sync with your camera now. So just time for one last question.
Good.
Slide 3 of your presentation talked about a decline in credit turnover, and I think that was marked for November. Can you just elaborate just lastly for us on what you mean by that, the decline in credit turnover?
Yeah, so in this particular instance, we're talking about the amount of disposable income that a business has. So I think we saw that tracking up a little bit over the summer, and that ultimately is probably as a result of the government interventions and money coming into business. But now that potentially suppliers are being paid off, rents have been met, or whatever it might be, we're seeing again another decline in relative income to those small businesses at the moment. And I think that's potentially, obviously, we're in another national lockdown. We'll continue to see that, and obviously some businesses have already maxed out their bounce back loan, amount that they can draw down. So I think it's going to be a tricky time over the next few months, even with the likes of furlough and Beebles being extended.
Thanks, Gareth. It is something that people will definitely be keeping an eye on very closely. But for now, thanks very much for your time and your presentation and for answering the readers' questions too. So that brings us to the end of the formal sessions for the Lending Summit. But in a moment, we'll have some closing remarks for you, and we'll be telling you about what else is coming up in the rest of the Credit Festival. So that's coming up in just a moment.